On my channel, I try to give lots of great advice and tips to help everyone become better investors. However, while there's lots of great advice out there, there's also lots of bad advice, especially across social media. Now in this video, I've taken some of the worst offenders and I'll explain why the advice is actually bad. However, there is a bit of a twist because some of the advice itself isn't the problem, it's more about how the advice is taken and what people use it for. Anyway, let me explain, and in no particular order, let's start with number one. To be a good investor, just buy good companies and hold them for a long time. Now, you get this one all the time, and it's something even the big man himself will say is one of the core reasons for his success. The advice explains itself. If you want to be a good investor, you just need to make sure that you invest in good companies and then make sure that you hold them long enough to enjoy their success. If you only hold a company for a short amount of time, well, you may as well go to the casino because anything can happen in the short term. And obviously, you only want the good companies because, well, who wants to invest in bad ones, right? However, the issue is that doing this is much easier said than done. I mean, think of this part first. What makes a good company? And how can I truly know if a company is a good one? I've got all of the books on my shelf from some of the best investors, and I could take all of the best tips and tricks from them to try and help on my journey, but I still don't think this would be enough. We could look at all of the financials to make sure they look good, make sure they have no debt, make sure they have a high profit margin, see if they're buying back their shares. Then for the rest of the research, we could look at whether the company has a strong moat, look at the industry they're in, and think about whether the company will do well in the future, no matter what's ahead. Now, don't underestimate how difficult this part is. If it was easy to identify a good company, then we'd all be doing the same thing. Then if we all did the same thing, the price of that company would get so high that the return we'd get wouldn't make investing worth it in the first place. Secondly, when people say just hold on to an investment for a long time, well, what does that part really mean? The fact is that most companies will not last forever, and if anything, the lifespan of a company is getting shorter and shorter these days. Take this part of research which I've shown before a long while back. In the S&P 500, did you know that the average age of companies has been getting shorter and shorter? Now, back in the year 2000, the median age of the top 10 companies was 85 years old. However, in 2018, it had shortened to just 33 years. And although this paper is a few years old now, the estimate is that by 2027, the average time a company spends in the S&P 500 will be just 12 years. Companies are getting disrupted at an ever-increasing pace as technologies completely change the investing world. What will the S&P 500 and the rest of the stock market look like in the next 10 or 20 years? I have no idea, but you can almost guarantee that it will look completely different from what it is now. So buy good companies and hold them for a long time? Well, good luck with that one. Be very, very careful. The second piece of advice you hear is this one. Diversification is for people who don't know what they're doing.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing.
I mean, you heard the man, right? As long as you know what you're doing, I mean, why bother diversifying? Just go all in, right? Again, sounds simple enough, and when you hear it, you might think, well, sure, as long as I study the business closely enough and I pick the right one, I'm going to absolutely crush the market and make loads of money. The reality, however, as all of you should know, is it's much harder than it sounds. You see, isn't that what every person thinks when they invest? They think that they're the special one that's going to beat everyone else.
So I'm not one of the bottle. I think I'm a special one.
In reality, the evidence shows us that only a very small number of people ever beat the returns of the market in the long run. If it was easy, then we'd all be doing it. And even though I know absolutely nothing about football, just think about this for a second as well. Think of the hundreds of thousands, maybe millions of kids who all want to become professional players. No matter what they do, there's only a few places up for grabs. Could you predict which kids will end up playing in the Premier League if you had all the chance to analyse all of them? You'd probably just pick your own kids, to be honest. But anyway, those odds are about the same.
I think I'm a special one.
Now back to diversification. The whole purpose of diversification in the investing world is to protect yourself from the fact that there are a huge number of risks, both with individual companies and with the wider market as a whole. An entire industry can be destroyed overnight or over a few years with a technology change. Likewise, any company that seemingly dominated their industry can find themselves in trouble that ends up with them on the scrap heap. Want some examples? I mean, you could make about 100 videos worth of these and you'd still have loads left to talk about. But just consider one. Imagine you're an investor back during the dawn of the mobile phone. You have all of the excitement from the dot-com bubble and technology is changing everything. The mobile phone business is starting to take off, and over the next few years, millions of units will sell all across the world. You'd have gone from something that you'd need to carry around in a large suitcase to now a handheld device with a battery that would last for weeks.
The orange system, this one is $779.99.
Now, during that period, you see the rise of Nokia. You see it keep gaining market share, you see everyone buying one, and you think, this is the right company to go all in on. If you got in at the right time, you'd see your investment soar, even if you take out the dot-com bubble. From a single share costing a Norwegian kroner to 23 kroner per share between the mid-90s and the early 2007 peak. At the peak, Nokia's market share of the mobile phone market was 49.4%. Now, what could go wrong? A growing market, a product everyone wants, and you've done all your research. Well, as you'll know, the next few years weren't so kind.
This is a day I've been looking forward to for 2.5 years.
Steve Jobs unveils the iPhone in the same year, and things slowly start to decline. Nokia gets complacent, it can't develop key software fast enough, the hardware becomes an irrelevant part of the smartphone market, and the rest is history. Nokia is still around today, but it's a shell of its former self. So if you hadn't diversified your investments, you'd had a very bad time over the last few decades. Can you imagine if Finance YouTube was around back then? Let me leave you this point by saying just one more thing. You cannot research the future. Okay, the third bit of advice. Be greedy when others are fearful, and fearful when others are greedy. This one is another bit of legendary advice, which, when done correctly, makes total sense. However, I think it's another one of those bits of advice that is wildly misunderstood and misinterpreted by people who have no idea what they're doing. This bit of advice all comes down to human psychology, and as we know, this plays a huge part in how we invest. When everyone gets excited and optimistic, the stock market can get carried away into a bubble, and it makes no sense at all in hindsight. Likewise, when things look really terrible and everyone thinks the world's going to end, you'll have people saying that stocks are going to keep crashing further and further. No matter who you are and how much of a strong stomach you have, we are all liable to our emotions getting the better of us.
Oh, wow!
Now, it's always important to remember that whenever the stock price changes, there's always a buyer and a seller involved. So at some point, even at the very bottom, there has to be a buyer allowing you to sell, and vice versa. There will be that one person who buys right at the bottom, as well as the fact that there will be some lucky person who also sells at the top. Whether that's the same person or not is another matter. Now, the point I wanted to make here was that if history has shown us anything, it's that the best investors just take all emotions out of investing. Legendary investor Peter Lynch said that the trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. He also said that if you sell in desperation, you always sell cheap. Now, this is all great if you're looking to pick stocks, but if you're a regular viewer on this channel, you'll know that a strategy I use personally is to use low-cost index funds as the main part of my own portfolio. I choose to own the whole market, and I invest every single month without fail. As I'm making this video, the UK has a new Prime Minister, the global economy is uncertain, and there is a huge amount to be worried about. However, when it comes to my own investments, as a long-term investor, I do not let anything change my strategy. When I invest, there is no emotion at all. I'd argue that I completely remove the emotion from it, and I pay no attention to whether the market's greedy or fearful. Quite frankly, there is no way to know if the market is at the top or the bottom. If you claim otherwise, you're welcome to try and time it if you like, but history should show you that no matter who you are, trying to time the market is a fool's game. Unfortunately, our human emotions will ensure that there will always be a steady stream of fools, no matter how many times we're told not to do it. I guess it's like when you tell someone they can't do something, it makes them want to do it even more.
Don't kick the baby. Kick the baby.
Okay, next bit of advice, maybe more of a comment that you'll see a lot rather than actual advice, but here goes. Warren Buffett has billions in cash, so therefore you should always do the same and make sure you have cash as well. This for me is fundamentally terrible advice, but let me explain exactly why it is. So, as you might know, Buffett's business, Berkshire Hathaway, includes lots of businesses inside of it that he either owns outright or lots of shares of. Now, as part of that, Berkshire owns a lot of insurance companies, and those companies have something called a float. This is basically all the money that they receive in insurance premiums that they need to hold in case they need to pay out. Now, in a good year, with not very many claims, they can make a profit on this float if they don't need to pay it out. Secondly, though, one thing they are allowed to do with this cash while it's sat there is, you guessed it, invest it. What has Buffett been really good at for decades? You guessed it, investing the float while it's been sat there. Now, some people might look at that pile of money and say, wow, there must be a huge crash coming as he's got so much cash and I better do the same thing. Firstly, I think this is confusing business finances with personal finances, which are two very different things. And secondly, it's misleading to look at the amount of cash on its own as well. Have a look here, for example. Here is the amount of cash and short-term investments that Berkshire has in relation to their total amounts of assets. As you can see, the average percentage is around the 15% mark from 2003 to 2023. Just because the number is a big one, and it does also make a good headline, does not mean that there is some crash coming and they're somehow ready for it. Buffett has been very clear that they like to be very cautious at all times, and their insurance flow has been one of the biggest reasons that they've actually been successful in the long term. Just going back to something I mentioned earlier, business finances and personal finances are not the same thing. You can look at any major company and see that they will have a large amount in cash. Suggesting that this is because they know a market crash is coming or something similar is just silly, I'm afraid. And if you run your personal finances like a business, you will spend a long time losing out to inflation and missing out. Don't, however, confuse this with suggesting that you don't need cash or some kind of emergency fund. That is not what I'm saying here at all. But I am saying that keeping 20% of your investable portfolio in cash because you think there's a crash coming is quite literally trying to time the market. Remember what happens to people that try and do that?
Kick the baby.
Okay, the final piece of advice. If you want big returns, you've got to take big risks. We've all heard this one, and there is a lot of truth here in many aspects of life. However, let me just play devil's advocate and explain why, in investing, you don't necessarily have to take massive risks for big returns. So here's a typical scenario. You've got a young person in their 20s and someone else a lot older. The young person says, I can take more risks with my investing because I'm young and I've got the time to mess up and start again. The older person says, well, I can't take the same amount of risk with my investing, so I'm going to have to invest in a different way. For example, the older person might just do what I do and invest most of their money in a simple global index fund and maybe have a few stock picks on the side. Whereas the young person says, well, I'm going to invest in those high growth companies that are going to the moon, something like Nvidia, Tesla, and Supermicro. After all, the young person says to the old person that they'll never get those 100x returns if they just stick to index funds. Only individual stocks can do that. And they'd be totally right, no doubt. However, let me just bring this back to the real world and show you some interesting stats on just how many companies out there actually do well in the long run. If you look at the whole stock market globally and take the 55,000 companies that are publicly listed right now, and then I ask the question, well, how many companies over the last 10 years have managed to give you 10x returns? Here's how many you'd actually get. For reference, if you want a 10x return in 10 years, you need 25% return per year on a compounded basis. How many companies managed to do that? 1,650 is all that did. So that's just 3%. Just for fun, if you want 30% return per year, only 1,025 companies managed to do that, closer to just 2%. And what about if you just want to make sure that you beat the average returns of the market? Well, only 6,498 companies managed to do just that. Finding the companies that end up getting all of the returns is really difficult. Don't underestimate just how rare they are. Secondly, and the point I was getting at with all of this data, is that the young person in my example doesn't need to take these risks in trying to find these companies. The young person has the biggest gift of all when it comes to investing, and that is time. If you can start investing early, do it regularly over a long time, then there's been no period of 20 years where you would have lost money to date. What's better though is this. Say the young person invests for 30 years with £200 a month and gets 10% a year on average over the long term. They end up with £416,000 after that time. Now, for the older person who only invests for 20 years, in order to get the same amount, they would need to invest £575 per month instead of that £200. Arguably, the younger person has taken less risk with less money each month and got great returns, something that doesn't apply to many things in life, but I think apply very well to investing in the long term. Don't get me wrong though, I'm not saying don't take risks in life or don't speculate. We wouldn't get very far in life if we took no risks, or I wouldn't have this YouTube channel. I just wanted to show you that you don't have to when it comes to investing. Anyway, I hope you found that useful. If you want to get started investing, check out the links below to the brokers I use. And don't forget to sign up to my email list with thousands of other people. I'll send you over my best ISA spreadsheet as soon as you do it. I'll see you in the next video, and as always, happy investing.